An undisruptive summer coupled with above normal temperature is expected to bring some respite for consumer durable companies after facing weak demand for the past 2 years. According to a report by Reserve Bank of India, confidence among consumers saw a sharp uptick as retail credit surged to 14% in the first half of FY22. Despite fears of COVID's third wave, the demand for consumer durables too saw a significant growth at over 69% to 28,409 crore rupees, hitting an all-time high. The air conditioner business grew by approximately 27% in volume terms and around 38% in value terms in March this year, reports suggest. While metros and urban markets continue to show strong demand, rural and semi-urban areas witnessed moderation. Dealers expect this healthy demand momentum to continue going forward. But there is a catch. Analysts expect rising raw material prices, especially that of aluminium, copper, and PVC, to weigh in on the margin of white goods and wire and cable companies in FY23. Rising interest rates are also an overall sentiment dampener as companies try to pass on the rise in input costs to the consumers. To offset commodity inflation, consumer durable companies took price hike of 5 to 10% in FY22. But earnings recovery in the first half of FY23 depends on how much price hike is passed on to the consumers. According to Pranjul Bhandari, Chief India Economist, HSBC Securities and Capital Markets India, dividing wholesale price index or WPI inflation into input and output prices, only 50% of the input costs over the past 6 months have been passed on. Generally, it's about 80 to 90%. In this backdrop, VK Vijaykumar, Chief Investment Strategist at Geojit Financial Services, believes margins of consumer durable firms to remain muted in FY23 as the industry cannot fully pass elevated costs to consumers.
There is a strong demand growth in the consumer durables segment. Smart rebound in GDP growth, easy availability of consumer credit, and the home improvement theme are assisting the rising demand. The scorching summer is an additional driver of demand. This will play out well for the consumer durables segment. However, margins are likely to come under pressure. There is a widespread increase in costs. Increase in metal prices, like the prices of steel, aluminum, and copper, have added to the cost. Increase in fuel prices have added to the transportation costs. The industry is unlikely to pass on the entire increase in cost to consumers because increase in prices will depress demand and depress volumes also. So there will be a part passing off the increased cost and the other part will be borne by the companies. So there will be pressure on margins. Also, since the segment is highly competitive, most companies don't have the pricing power to pass on the entire increase in cost to consumers. So the net impact of all this will be reduced margins for the industry. But some companies with very strong brands will succeed in compensating the reduced margins with increased volumes and revenue. The recent decline in metal prices also is a positive.
Except Blue Star, shares of consumer durable companies like Crompton Greaves, Voltas, Havells, Orient Electric, Whirlpool, and V-Guard have been under pressure as they bleed from 8% up to 21% this year. In comparison, S&P BSE Consumer Durable Index and S&P BSE Sensex tanked over 16% and 10% respectively during the same period. Moreover, the sector is sensitive to rising interest rates. With a surprise rate hike of 40 basis points by RBI, consumers are likely to spend less on discretionary items in a cash-strapped economy. Analysts believe that only companies having higher scale and lean cost structure will be able to manage cost inflation better than peers.
There are certainly many structural drivers in place for the consumer durable companies to expand. The low penetration of white goods, the pent-up demand, as well as a healthy upcycle in real estate segment all augur really well for these companies. Plus, due to the soaring temperatures this summer, consumer discretionary spending from other categories is expected to divert to cooling devices. So from a demand perspective, especially from semi-urban to urban areas, the demand seems fairly robust. On the other hand, the unabated inflation continues to remain a pain point for these companies and keeps them in a tough spot. Now, why is that? This is primarily because if these companies resort to protecting their margins and doing incremental price hike, it can eat up in the demand, especially from the rural areas. So most of these companies have resorted to protecting their market share and increasing their sales at the cost of margins. And this is certainly weighing down on the stock prices. So considering all this, and due to the never-ending dilemma of these companies of whether to pursue growth or to protect the margins, I believe that the re-rating for these companies, at least in the near term, seems quite limited.
Overall, analysts expect 2022 to remain mixed for the industry depending on revival of economic indicators, improvement in supply chain dynamics, and consumer confidence. Lastly, benchmark indices closed lower for fifth straight day yesterday. Both Nifty 50 and Sensex tumbled over 2% each. Delivery IPO was subscribed over 23% on day 2. As regards today, investors will watch out for Q4 results of Tech Mahindra, Escorts, and Bandhan Bank.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.